Hello, and welcome back to another edition of Not Fintech Investment Advice, the podcast where Simon Taylor, author of Fintech Brain Food, comes on to talk about fintech companies that have caught our eye recently. In today's episode, we cover quite a wide range of different topics. Obviously, we talk about AI because we have to talk about AI, but we talk about it in a way that we haven't in previous episodes and really delve into some of the less sexy areas behind the scenes in financial services that could benefit potentially from generative AI. We also talk about BNPL, one of my personal favorite topics, and its defensibility in specific industries where there's high expenses and less sort of embedded technology. And then I bring a really interesting company to the table that is working on figuring out a way to build an operating system for recent immigrants. So again, pretty diverse episode. We cover a lot of different topics. We get into a lot of different esoteric areas. Simon, as always, is a delight. He also had some very exciting news to share at the beginning of the podcast. So make sure that you tune in to this episode starting now, Not Fintech Investment Advice. This is Fintech Takes, the podcast keeping you in the loop on all the latest fintech trends, news, and ideas. I'm Alex Johnson, creator of the Fintech Takes newsletter, your host and self-confessed fintech nerd. Let's go. Okay, Simon Taylor, as always, is back in the chair and ready to talk fintech companies. Simon, great to see you.
Good to see you, my friend. How are you keeping?
I am keeping quite well. As we were talking about before we hit record, post-Labor Day here in the States, kids are going back to school. The younger one is starting kindergarten. So there's that kind of back to school energy and it feels good. How about yourself?
Yeah, back to school energy. First time at school in kindergarten for my eldest. So very excited about that. We've got the school uniform, which you have to wear in the UK. All set up. My daughter was not happy with the school uniform, but she's going to have to go. And she's going to have to do it. So fun times. And at the beginning of the school semesters and terms is usually the beginning of conference season. So hopefully survive another one.
That is very true. Well, I know for a fact that I'll see you out on the road. You'll be hopping across the pond for at least one or two events, I think. And so looking forward to that. And Simon, looking forward to getting to learn a little bit more about new things happening in your career. Do you want to give us a little breaking news here on the Not Fintech Investment Advice?
Yeah, sure. So I have some personal news. Yes.
As they say. I
have changed my role at Sardine to being an advisor. I love those human beings. Please go work with them. They're wonderful. I'm joining Tempo. And everything I'm about to say are personal views because there's still a lot to work on. But Tempo, as you're probably aware by now, is the new payments focused blockchain, or the blockchain designed for payments is one way to think about it. So you've probably seen my writing lately. I've been talking a lot about stablecoins. And my story in sort of like stablecoins and tokenization goes back more than a decade when I was head of crypto R&D at a bank. I often joke that I'm crypto's disappointed dad. I've always seen the potential in it, but it never seems to quite get away from, financialization or memes or things of that nature. But with Tempo, I saw a real opportunity to make a meaningful difference in payments. And I've worked in payments pretty much my whole career for about 20 years, whether that's in a bank or somewhere else. So why Tempo? Well, it's a payments-focused blockchain entirely focused on payments. You can't do a meme coin on this thing. You cannot do DeFi on it. It is just for payments, we know stablecoins give you instant 24/7 global settlement of transactions, but the blockchains are limiting some of their upside. And what if you could start from zero? And what if you could bring together some payments nerds to try and make that happen? So it's created and incubated by Paradigm, the VC firm, and Stripe. but there will be a whole bunch of design input from folks like Anthropic, Coupang, DoorDash, Nubank, OpenAI, Revolut, Visa. Like, this is designed to be like, let's learn from the best and many others as well, and figure out, how do you build payments infrastructure for the internet that's neutral and available? And I'm already waffling because I'm just so excited by this thing. I can't help myself. I just think it could be really, really cool. So that's what I'm going to be doing as my day job.
I love it. Well, congratulations. You certainly have put yourself in a position to earn this type of opportunity because, as you said, you've been writing and talking and exploring this space longer than almost anyone, and doing it in public, which is a hard thing to do. So congratulations on the new gig. That is fantastic. Can we assume that you'll still be doing all the wonderful content things that you already do?
100%. So you can expect FinTech Brain Food in your inbox every Sunday. You can expect FinTech NerdCon to be the most fun event you'll ever go to. Tickets are available now. And if you are listening to podcasts, the Tokenized podcast is available every Monday wherever you get your podcasts. So yeah, no, I can't help being the content guy. I gotta give a shout out to the Sardine guys. I think we created a model with creator in residence, and it really works for me. I really like it. So I'm going to be doing a lot more of that.
Well, again, congratulations. Very, very exciting news. And, since we still have you content creating and appearing on this podcast as well, do you want to talk some fintech companies?
I do. Do you want to go right ahead? Because I feel like I talked a lot, and I want to see if you've got an Alexi company or a Simony company this week. Where are we going?
Sure. I have a couple interesting ones. The first one, and I would classify this as an Alexi company, although a little bit different maybe, is called Welcome Tech. And Welcome Tech has actually been around. It's totally inclusive. That's the whole goal. Because what they do, and you'll like this tagline, Simon, is an operating system for immigrants. Oh. And so they are essentially building a sort of all-in-one digital platform to help new immigrants. It's a U.S.-based company, so we're mostly talking about immigrants to the U.S. It does seem to be oriented towards immigrants from Latin America, Mexico, but of course, I'm sure the platform is extensible beyond that. And it's really interesting. It just raised some money, which is why I kind of came across my my radar. They raised $7.5 million in funding. This follows on a couple of much larger rounds of funding that they raised in 2020 and 2021. So kind of, I think in some ways, the kind of classic fintech story where raised a lot of money when money was really cheap and easy to come by, raised a little bit of money more recently. It seems like in a more sort of focused, perhaps slightly less ambitious way, which is kind of the time. But I really like the general premise here, which is, I guess I would almost kind of think about it as sort of the consumer equivalent to what we're seeing on the B2B side with vertical SaaS companies, right? Where it's like an operating system for daycares or an operating system for restaurants or an operating system for this. Like, I like this general mental model of here's an all-in-one inclusive digital environment that gives you all the tools you need to do X, to do this job. Makes a lot of sense in a B2B context. I've always thought that same line of thinking makes a lot of sense on the B2C side, but it's harder to figure out what the job is to do, right? Because, apart from people's professions, there's not necessarily a lot of things where it's like, hey, this is, X for Y. Like, it's kind of a more difficult proposition to come up with on the consumer side. Recent immigrants, though, present a really, I think, good case study because there is a set of jobs to be done there that are probably fairly similar, that are very difficult, and that are benefiting, I think, from a focused tool set that can help them do that. So, Welcome Tech includes everything from sort of educational resources to a pretty comprehensive set of embedded healthcare services. So telemedicine, dental, vision, prescriptions. It includes kind of job placement services. And then it also, as relevant to fintech, And TTV Capital is one of the investors that participated in this most recent round. They also offer sort of embedded financial services. So a digital wallet, a debit card, kind of all the things you need to get started as a new immigrant in the US. And, Simon, the reason that they were interesting to me, apart from all the things I've already described, is I also think it's happening at a really interesting time. And this is going to verge us a little into politics, which we don't always get into on the podcast, but just for a second, immigration is obviously kind of a lightning rod in the US, in the UK, elsewhere. But one of the things that I saw reported on recently is that 2025 in the US is shaping up to be the first year ever where the US loses population rather than gains population. First year ever that has happened. And obviously it's a result of a declining birth rate, which is happening globally everywhere, combined with, of course, a significant curtailing of immigration. And, demographers, economists, anyone you talk to who sort of studies this stuff, what they will tell you is the economic consequences of losing population are just very, very bad, right? Like, setting the politics aside, losing population is very, very bad. And I wouldn't totally be surprised, even though at this moment politically, immigration is sort of out of favor and we're really trying to sort of reduce or crack down on immigration. I wouldn't be surprised if, due to just basic economic realities, immigration in a legal, well-structured form does sort of come back in vogue, maybe sooner rather than later. And we're in a pretty politicized environment where things tend to swing back and forth pretty rapidly. And I'm just very curious about a fintech company or an infrastructure company or B2C sort of operating system that's focused on an area where kind of reminds me of mortgage almost, where it's like very cyclical, like either the thing you're building for is booming or the thing you're building for is kind of shrinking. And the timing around it is just fascinating because, again, they raised like close to $70 million in funding in 2020 and 2021, which was, from a VC investment perspective, a very different environment, but also from an immigration and politics perspective, a very different environment. And I'm fascinated to watch this company kind of continue to chug along because clearly the infrastructure is needed, but like when it catches a wave and kind of hopefully grows beyond it, that's the open question.
Yeah, there's so much to be said for timing with a business, isn't there? Like this is
Totally.
absolutely the right proposition. And you have to wonder, like, intuitively, it sort of makes sense, this proposition. I've just arrived. What's my operating system? And yet these things, I've sort of seen this model in other consumer segments not really take off. I mean, goodness, right. 7 or 8 years ago, McKinsey was going around calling this the ecosystem play. And it's quite common in China that you have these ecosystems around homeowners and car owners and, Ali and Tencent and others and Ping An. All of these companies build these ecosystem platforms where if you're a car owner, you can do everything from find your car, shop for it, finance it, insure it, service it, all in one platform. Homeowner, find your house, mortgage it, service it, get renovations done, home equities, release, and all of that, all in one platform. It hasn't really taken off in the West. And these operating systems, these consumer ecosystems, that was my first thing when you started talking. It's like, do they not get product market fit because nobody's executed them well? Have they not found the right wedge? And then I don't know how many fintech companies you've seen expressly or at least targeting the immigrant population as its go-to-market.
It's quite a few.
But I can't name one that's like huge. But I can name lots of fintech companies that have done really well that happen to target them, but also target anybody that's a lower income population. Like it's kind of more common. You see a lot more chimes than you do these things. So that was kind of my like overall segment piece. To your broader like immigration down, that's where my timing thing really comes up. Like maybe immigration down, maybe. But maybe there's also a way to say your operating system therefore needs to change. It's not help me get set up with all of this stuff. It's help me manage all of this stuff. Because one thing that can easily trip you up if you've not got a lot of money and you don't speak the language is the paperwork. And being tripped up by the paperwork is something that is a lot easier to avoid if you've got some money, because lawyers. But if you don't have money, the lack of lawyers means that you can believe something's true when it's actually not, or might not have been, or you could work the system in your favor. Tax code is another classic example. So I wonder if here there's a pivot opportunity, rather than just being the operating system for people that have just arrived, be the operating system for people that need to thrive. How do I help you manage everything you're going to have to manage in potentially quite a challenging environment, especially if you're first generation or recently migrated, if you work cash in hand and you're looking to come into the formal system? Like, how do I make that as easy as possible so that you are a tax-paying, employed, productive member of society that's on every registration they need to be on, and can give your family some comfort and security? Like, I wonder if that's an opportunity.
Yeah, it's a great point. And I'm going to hone in on the word security, because I think that's the other element to this that's really tricky is, particularly in our current political environment, safety is kind of the key concept here in a lot of ways, right? And I think you're right to hone in on the paperwork. Like, a lot of the, I think, challenge is not so much logistical, although those are definitely challenges as well. It's more a sense of, am I crossing every T and dotting every I exactly the right way? Because I don't want to be, forced to leave based on a technicality. I don't want to do something wrong. Like, my intent is to do everything the right way, but just because my intent is to do everything the right way doesn't mean I'm not going to make a mistake. Because let's be honest, I mean, I'm a citizen of this country. I make mistakes dealing with the paperwork here a lot. It's really, really complicated, to say nothing of if you're not familiar with that system, if you don't speak the language, obviously, if you don't have the money to afford paying a lawyer. So I think, like, reorienting around, to your point, thriving, and reorienting around safety, right? And helping you establish like a safe foundation for living and working in this country. I think that is a really good position. And I get the sense, just looking at the information around their most recent fundraise and kind of how they're positioning it, obviously it's a smaller amount of money relative to what they'd raised before, but they're talking a lot about AI, which I actually think in like an agent context is pretty interesting here, because as we've talked about in previous shows, like, agents can kind of be a stand-in for expensive lawyers when you can't afford one, and help with some of that stuff. So I think that potentially is an interesting opportunity. And then I also think that, their discussions around integrations with employers is pretty interesting, right? Because that's another area where, kind of from like a safety perspective, like, if you can work with employers, if you can work with other entities that are sponsoring or in some way trying to assist you in establishing yourself in this country, that's just another sort of on-ramp into a kind of a safer standing. And so I think they are kind of pivoting in this direction. But again, to your point, these operating systems are a hard play to make work. We haven't seen a lot of examples of them working on the consumer side in the US. And, again, like, the timing thing is just really tricky. And I don't love when timing is the thing that screws up things that otherwise should exist, but it happens all the time in fintech, right? I mean, like, I can't tell you the number of fintech companies I've come across where I'm like, I love this. Your timing is terrible, but I love this. And so I'll be interested, much like in mortgage, if we can see this one kind of survive the counter-cyclical swings that we're going through right now.
Well, how many companies came to market in 2020, 21 with like some DeFi yield product that went on to become treasury management and just selling T-bills, and and now they're doing DeFi yield again. Like, it's
right.
Your product may change, your proposition, your product, something. You know what I'm trying to say? Like, the actual underlying technicalities of how the product works may change, and your go-to-market may change quite a bit. But the core idea or the core problem you solve could still be very much the same thing. So I think it's entirely possible.
Yeah, no, I agree with that. And, I hope that it sort of can sustain through this next couple of years. Simon, give me your first company.
All right. I am going to talk all about Bumper. Bumper is, I guess, the name of like the would you guys call it a fender? I suppose like the edges of your car. So this is a British company.
Fender, yeah.
Yeah. So and what they do is BNPL for car repairs. So imagine if Fender did BNPL for car repairs. Mm-hmm. So it helps customers split the cost of repairs and servicing into monthly interest-free payments. Now, the distribution here is they've gone to all of the auto dealers, so 5,000 auto dealers in the UK, and users will come along, select their dealership, enter the details into their app, book an appointment, and then they get to spread the cost. And immediately I thought, does every niche get its own BNPL provider? And what would be new here other than the go-to-market? Mm-hmm. I can see something really valuable in servicing the niche, but why wouldn't every auto dealer choose Klarna or Affirm if they could? Is it just that this is a distribution channel that's quite hard to get into? Is it that auto dealers tend to be quite manual and disaggregated? And, it's an industry that's not necessarily always been the most obvious tech first. Maybe there's some vertical SaaS that could embed a Klarna and kind of get you there. I've seen certainly dealership software. But yeah, I wanted to get your views on this. Do you think that BNPL as a category, is it becoming mainstream? And B, can you imagine it getting more niche like this? Or do you think that it really belongs to the Klarnas of the other firms of the world? We just saw Klarna's going to IPO. Finally, they've published their data. Affirm just had a record quarter and finally hit profit. Maybe BNPL's here to stay, and maybe its evolution is in niche. What are your thoughts?
Oh, it's a great question. This is an Alex company, Simon. Despite using this term bumper that I don't associate with real cars, but we'll set that aside. Yeah, it's very Alexy. I would say a couple of things. I mean, I do think BNPL is here to stay, and in some senses, as we've talked about before, BNPL not a new concept, right? We've had point of sale lending or sort of lending in these environments. Like I always think of. Like elective financing in healthcare is a field that's existed for a long time, well before BNPL became a term. So these sort of specialty financing for expensive consumer purchases that are embedded within the providers of those services, like those have existed for a long time. However, having said that, I do think that BNPL, just as like a consumer force, has kind of rewired consumers' brains in a couple of ways, right? So one is, I think, and Max Lepchin at Affirm talked about this in the earnings call that they did for their latest quarter that just closed. Once you sort of experience what Affirm calls honest financing, which is to say like straightforward, no catches, that kind of stuff, you do sort of become accustomed to it. And it does become a bit of a differentiator relative to other forms of financing. And so, I mean, like I would not want to have to finance, a car repair on a credit card. Like that would not be a good choice for me, right? Like I wouldn't want to do that. And I'm not sure how it is in the UK, but like it's pretty inconvenient to just go get a personal loan for sort of any sort of unstated purpose, right? Like the thing that's nice about credit cards is they're just with you all the time and you can use them. The bad thing is using them as a debt facility is really expensive and can drag you into sort of revolving debt hell. So having embedded options everywhere for installment lending with very clear terms and fees, I think that is a trend that is going to accelerate. Your second question, though, about like, is this a niche or is this just something that gets eaten by Klarna and Affirm over time? That one is trickier because I do think that one of the things that I've spent a lot of time thinking about actually with Klarna and Affirm is they are both like a good thing and a bad thing, I think, for merchants in the sense that they obviously provide value to merchants. They drive greater average order value, more revenue, more sales. So like they have an incremental value that they can demonstrate to merchants. Fantastic. However, they are both very actively trying to build direct-to-consumer facing businesses where they're not exclusively going through merchants. And in fact, they are using, and this has been written about before, they're using their merchant channel as a negative CAC mechanism for getting paid to take on new customers. So it's a very efficient way for them to acquire customers, and then they'll acquire the customer and they'll send them other places, or they'll do advertising for other merchants, or they'll just do stuff that's not necessarily in the merchant's best interest. I wonder if the defensibility around BNPL that's more specialized starts from the perspective of, hey, we're not going to take your customer from you. We're not going to try to remonetize them in some other way. Like, this is your customer. If you're a car dealership or you're like an auto repair shop, I imagine that your business really depends on like word of mouth, returning customers. Like I would imagine like retention is very key. And I wonder if that's part of the pitch. And then to your earlier point, and I know this one for a fact, at least in the US, the technology inside car dealerships and auto repair shops is really antiquated and manual. It's a lot of paper. And so I imagine there is a pretty significant moat just from a go-to-market perspective if you can crack how to integrate your stuff into those places. And you know, in the States, we have at the dealership level on the sales side, like Route One and Dealer Track, which are the indirect auto lending networks. And that's like classic embedded finance. But I can tell you, like, those things are impossible to dislodge. Like, they are literally going to be around until the heat death of the universe. And so if you could build the equivalent of that or tie into the equivalent of that on the service side at dealerships or at independent auto body shops,
it's white space, isn't it?
It is. And it's like, it's, you know, I mean, we always talk about, you know, do hard things that don't scale as sort of a mechanism for building moats and building companies. I could see that just distribution and doing that hard work that doesn't scale being a pretty effective moat to keep out, you know, the Affirms and Klarnas of the world who, quite frankly, have enough other fish to fry that they might just not pay attention to your little segment.
Yeah, I think that fish to fry thing goes back to your earlier point about like I think you said rewiring the consumer's brain. Something I wrote down earlier is like BNPL is the default for two generations, Generation Y and Generation Z. Like they absolutely prefer this to credit cards, and you know, outside of maybe Chase Sapphire because of the rewards type of stuff, even Amex is doing really well with its pay later and pay in installments plan for the affluent segment. Like,
everybody likes it.
I think Max Levchin's point is absolutely true. Once you've experienced that sense of control, it's very hard to give that up, and you don't want to go backwards. You don't want to just get a regular credit card. And why would you? That sense of control, I think, for consumers is really interesting. And these businesses, I think, where they're going, well, both Affirm and Klarna have launched their cards. And Affirm in particular, its GMV growth has been driven by its cards. They've got, 1.2 million card users, but it's absolutely doing really well. And what's fascinating to me about that card business is that how many financial institutions have tried to launch like a BNPL or a pay later on cards and not stuck that landing, and nobody likes it, nobody uses it? BNPL is a credible threat to those bank businesses, but I think the reason they've not succeeded at launching pay later or BNPL type products is when your P&L for the cards business is really driving the wagon. Like, that thing is extremely profitable. You don't want to touch that P&L. That is a powerful force inside the bank. And you come along and say, there's this less profitable product that gives consumers more control. We should push this really hard. That's not going to survive the innovator's dilemma internally very long. It's very hard to disrupt yourself. Whereas if you are like a BNPL provider, it's all upside. It's all cross-sell. And these organizations really do want to wrap themselves around consumers, starting with the card and the flex credential and all of that sort of stuff. But Klarna could go into savings and many more things. So I agree with you. I think that they are going to stay away from some of these harder to distribute to niches. And I wonder if there are other hard to distribute to niches, because the experiences you say of like sitting down at a point of sale and going through point of sale finance in a dealership is just pure agony. It's like going to visit the dentist or having some long form consultation where you have to fill out a bunch of paperwork and you can't do any of it digitally. Like, it's going back in time. It's a really weird thing. So yeah, like this could have something. I thought it might tickle your fancy for that reason.
It does. It does. No, I mean, and I think the last thing I'll say on this one is just that there is, I think, something nice about fintech companies that sort of embody that kind of aim small, miss small mindset, right? Like, not everything needs to be a firm and Klarna. Not everything needs to be that big, right? I think there is definitely a benefit to having a more focused market where it's like, look, we're just going to really crush it here. And obviously, I mean, I haven't looked at the numbers on the sort of global market for gross merchandising volume on car repairs, but it's huge, right? It's like gigantic. Like that by itself is a plenty big market to go after. I do definitely see a trend towards, like even from a venture capital perspective, like VC firms trying to be the first and only check into a company that's not going to get as big from a revenue perspective. But if they can help them get to profitability and get to a good exit and not dilute their equity too much, it can be a good outcome for both sides. And so I do think we are kind of trending in some ways back to smaller companies, both from a VC perspective and from a founder perspective. And there's lots of little niches like this that are plenty big for a company to do really well in without like rising to that $10 billion valuation level that we kind of became obsessed with in 2020.
Well, in the age of AI as well, if you can generate some of these apps, if your back office is almost nothing, like you could almost solo found one of these things. If you have the right network and relationship in distribution, it's like, it's almost thinking what sort of little hacker, coder, entrepreneur has this weird esoteric career in which gives them access to distribution, and how do you find those people? It'd be really interesting game to play. Can I possibly trouble you for your second company? Would that be too much to ask, sir?
No, not at all. And in fact, I am going to steal from you, Simon. So the thing about you is you publish a bunch of fintech companies in your newsletter every week that are very interesting. And occasionally I'll, obviously I read your newsletter every week and I'll troll through those companies and see if there's one that strikes my fancy. And there is one, Simon. So I'm going to steal it from you. Are you ready?
Yeah, go on, you thief, you. I thought everybody from Bozeman, Montana was really nice, and you had me fooled.
I did. It's been a long con, and it's all coming to this moment wherein I steal the company that you wrote about recently, and I'm not even sure I'm pronouncing this right, Scalar Field. Is that striking a chord with you?
It does, but I have many children that I've written up.
Yeah, you can't even remember all their birthdays now, can you? That's so funny. Well, I have it pulled up, so I'll read to you what you wrote. We'll go from there. How about
good.
That?
Very helpful.
Quoting Simon Taylor, Scalar Field lets traders backtest their strategies on live company data and headlines. It helps benchmark an existing proprietary portfolio against market indices and will generate Python code to help analyze new events. At first glance, this looks like Perplexity Finance, but the video use case shows you more. The focus on backtesting is a really good example. While trying out trading strategy can be modeled in real time using real data, this lets traders react faster. So this is sort of an AI-powered company researching and sort of portfolio trading tool that allows traders to essentially sort of apply their existing strategies to new things that have happened or to backtest what's happened. And Simon, the reason this company struck me as interesting is not really so much to do with the market that they're in. And, I love investment banking and trading as much as the next guy. Not really my core field or area that I care about that much. But I did think that this is a really interesting example of, I always think about like, where are we applying AI that is sort of retreading old ground that's already pretty well solved for versus where are we applying AI in an area where our existing technology just can't help us at all. And back testing strategies is one of those areas, right? I've sort of come to believe, and this is my lending background speaking a little bit, but it is really, really difficult to simulate or to back test strategies or models against like real world data, right? And so the way that a lot of model development works today is you get a historical data set, You run that data set through your different modeling tools. You find sort of attributes or variables that you think are predictive. You sort of construct them in a way that gives you what you think is a predictive output. You go through a whole sort of model benchmarking, validation, testing process. You go through a whole other process to implement that. And then you sort of hope by the time you get your model into production, that model still works and that the world hasn't changed and that everything is going to be relatively steady so that you can wring some actual real world predictive value out of the model that you spent so much time developing, testing, and implementing. And then as soon as the model starts to drift, you go back to the lab and you start that whole process over again. What would be much better would be to have the infrastructure that would allow you to essentially model to monitor your model in real time as the world continues to evolve. And we just haven't really had the tools necessary to do that for a lot of reasons, not the least of which is a lot of the data that you want to monitor your model against is unstructured data. It's sentiment data. It's things that are very difficult to plug into classic machine learning tools. And so, as a result, what ends up happening is if you talk to anyone I'll just use lending and credit risk as an area since I know it reasonably well. You talk to anyone in that space about simulation or monitoring model performance, they'll all talk to you about, oh yeah, we have a product that can help you with that. But the product is actually just packaged consulting work that they're going to do for you, right? It's humans doing something on an hourly basis, right? And the reason for that is, again, the inputs necessary and the reasoning necessary to do that well are just so diverse that machine learning just can't handle it. You need humans to do it, whether you're paying for a product that's actually just packaged consulting or you're doing it internally. Humans have to do it. I'm really intrigued by examples that are out there. And of course, wealth management and investing and trading is where a lot of this stuff tends to happen first, since that's where all the money is. I'm really intrigued by the idea of applying AI to this sort of model backtesting, model monitoring, model performance question. I know you wrote about these. What's your take on that?
Yeah, I think it's much harder to do with unstructured data, which is why I found this fascinating. Look, I'm thinking with my sardine hat on for a second. It's very common to backtest stuff in fraud because your signals are typically reasonably structured that you're looking at, right? You're looking at device and behavior and click streams and transaction data and anything that you can get your hands on. You tend to have fairly-ish structured data. There's still a lot of data science to do, but you can backtest. Which one of the things Sardine and a lot of its competitors do is give you that real-time backtesting, create something new, simulate what it would look like. When it's thousands of PDF reports or the latest jobs report or something coming out of S&P on consumer credit health,
right?
How do I pull that in the first place? And if you forgive me, I'm going to try a not Fintech investment advice first, and I'm going to try a segue to the company I was about to mention.
Oh, go.
Because Structify is the data science AI agent for finance teams. So it helps you create pipelines using natural language from a data source to data you can use. So it automates a lot of that messy work of fixing format inconsistencies, removing duplicates, and creates a single clean output that you can kind of iterate on. And oh my goodness, I don't know about you, but I used to work a lot in trying to get stuff into production and pull something out of a database and squeeze it somewhere else. Three letters that still scar me are ETL. Extract, transform, and load, or ELT if it would be technically correct. Database administrators, do you remember DBA? You're wrestling with multiple structured sources, and then you throw it a PDF, and it's like, what on earth is this? And how am I going to pull stuff out of the PDF? And now I'm have to pull out strings from an image model. Oh my God, I actually did that once. It was extremely painful trying to pull things out of PDFs in the early 2000s. And then to try and put that into a database that makes any kind of sense, incredibly hard. So I can see why Structify would enable lots of people to build something like a Scalar field, because there are so many use cases where unstructured data is extremely useful. And these LLM things just happen to be very, very good at taking a screenshot, taking a PDF, getting access to some API and going, yep, okay, here's some logic and rationale on it. And you want to plug me into your proprietary data, can do that too. I think what Structify does is help you make sense of the data and make it ready to use. What Scalar Field does is securely connect that back to your existing proprietary data and let you run those models. So I'm with you. I think this revolution in unstructured data for forecasting and backtesting is there for the taking. We'll see lots of companies doing it, and I really do think it's the frontier of finance in so many ways. And typically you see the frontier of finance appear first in capital markets, as you say. But I was speaking to Luke over at Pipe, and he's putting a lot of time and energy as a lending business into how does this start to impact his underwriting rationale and logic. And I would expect that's true of anybody who's a specialist in lending is now you're trying to build your own version of this. So you got me going there. I don't know where to go next, but interested in your thoughts.
I'm glad you combine those two, right? Because they kind of are two pieces in the same puzzle, which is that I've been thinking about this a lot, actually. We've gotten really obsessed with automation in financial services over the last 35, 40 years, right? So
straight through processing, my friend, STP.
Yeah, right, exactly. I feel like the last 3 or 4 decades, it's all been what can we just remove human beings entirely from and just automate the shit out of this? And what's funny is we got really good at doing it in certain areas, right? So to use the example we're kind of using right now, once you have a model, you can deploy the model into a decisioning environment. That decisioning environment runs on a set of automated rules. And in the vast majority of cases, whether you're doing fraud or servicing or origination or transaction analysis or whatever, you can basically automate 90, 95%, 98%, 99.99% of transactions. And then a very small percent that are flagged as risky get sent for review. But the vast majority is just straight through processing, and that's what we do. And I think one of the things that's challenging when we've trained our brains to think so much in terms of automation is we sort of stopped. You know how sometimes I think a good analogy is in your house, how there'll be a part of your house that's unfinished. You just didn't wire that socket, or you didn't nail that last thing down or whatever. I'm speaking your language right now. And if you let it go too long, your brain just gets used to it, and then you don't see it anymore. You just walk by it, right? I was in my parents' house that they've lived in for 35 years, and in that house there are lights embedded in the wall that just have never had a light bulb put in them. But they've been that way for 35 years, and none of us see it anymore. We just walk by it and we don't even notice. I think in financial services we do something similar where things that can't be automated, we just don't see anymore. We don't notice. We're it's not even worth thinking about. But the reality is, if you think about modeling and decision making, the last step is really well automated. And there's lots of straight through processing. Every other step is horrifically manual and expensive and slow. And, really, really great financial services companies find ways to wring differentiation out of those steps. But they're not fast. They're very expensive. They're not efficient. There's lots of redundant work and handoffs. And as you were saying, transforming unstructured data into structured data by tasking some poor soul with actually moving data from this row into this column. It is really mind-numbing work. Someone described kind of the way we use machine learning in financial services as an elaborate magic trick that takes 2 days to set up for a 15-second trick that amazes the audience. That's kind of machine learning. And it's not because the magic trick isn't cool. It's because all the setup required to get the magic trick in exactly the right way and have it set up and configured the right way to actually dazzle people, that's where all the work is. We sort of stopped paying attention to that because that's not stuff we could automate with decisioning systems or with classic machine learning tools. We can maybe not automate it, but we can augment and make much more efficient those processes with large language models and with generative AI. And so to me, like these two examples, both of them are ones where I just think like that is where a lot of the value is going to be unlocked over the next 5 to 10 years. Maybe eventually generative AI becomes something that can fully automate stuff. But until then, there's a lot of manual work that if we can just augment it and make it more efficient, we're going to be changing lives and changing business models.
Do you know what's really surprised me? I would have thought that the only people that would adopt this would be the innovators, the companies that are going to be born today, or like what I'm lovingly terming the millennial tech companies.
Sure.
The companies that have been around a little while. Then maybe they've IPO'd, maybe they're pre-IPO, but they're big enough to be scale-ups, I guess. Those companies could absolutely adopt this stuff. But what's really surprised me, speaking of financial institutions, is just how many already use Cursor or Devin from Cognition Labs, how many are using Vercel or Lovable. And that's a really surprising thing, is like the actual AI tool adoption inside of traditional financial institutions is surprisingly good. The hardest thing to change in a financial institution is their operating model, the way the sausage gets made. That's where I think there is a little bit of a differential here. If you can't get your budget signed off for 12 months to do something, if you use a program management office and that program management office needs to consult with the audit committee before it can unlock a change to a process, and that needs sign off from this other committee. Can you feel my scar tissue from having been there? That stuff is probably more the blocker. That there was some team that was offshore that were the people that would do the ETL, and nobody really feels this pain, and this pain is kind of hidden. And so I wrote a piece a couple of years ago from offshoring to AI sourcing, or from outsourcing to AI sourcing. We just pushed this problem outside of the bank. To the lowest cost provider, this has to be done. It's kind of commodity work. We care that it's accurate, but we don't care that it's good. Just follow our procedures and follow it exactly. Whereas AI sourcing is a different model, which is, well, maybe we could do this way cheaper, yes, with AI, but maybe we can push that closer to our IP and our special sauce and the human creativity without necessarily requiring 1,000 people to do this thing. So I do think that mental model shift of how do I organize my team is going to be the hardest thing for people, not the kind of use of AI. There was that study by, I think it's MIT, that said 95% of AI projects or generative AI projects fail. And this inside large financial institutions, and I'm not surprised. They were paying lots of consultants lots of money to do AI projects. What did you expect? But I think so much of it is bumping up against the operating model, not necessarily the desire, or it's not a lack of intelligence. It's not a lack of intent. It's a lack of ability to execute inside your operating model that's holding you back.
No, I totally agree. And, AI, for its many wonderful capabilities, can't solve those problems. You have to solve those problems, right? You have to structure these. And this is why you see, people like Toby at Shopify getting a little aggressive maybe on instructing the company on what my expectations are for how we're going to use AI, and not letting politics or sort of existing organizational structures or the way that people do their jobs today get in the way of that. You have to kind of really do a strong cultural course correction to get people to embrace this stuff, to use it in the way where it can really add value. Because you're right. I mean, the word sabotage comes from, French weavers smashing automated looms with their boots. That's where the word sabotage comes from. Like human beings will go out of their way to stop these things from happening if they feel like their cheese is being moved from one room to another. And I think in a lot of cases, you're right, the problem we're going to have to solve to make a lot of this work.
Like the bank lobby with stablecoins.
Not unlike that, which, Simon, is a topic I want to get to in another episode, but I think we've used up almost all of our time today. Before I let you go, can I manifest something real quick?
Please do.
Okay. This is not so much a product thing as it is a mindset thing, which has kind of been our theme lately as we manifest things, but I wrote about this in the newsletter. I would very much like it if banks and incumbent fintech providers that work with consumers could choose to view the rise of gambling and speculative financial investing as their problem rather than just as a choice that consumers are making that has nothing to do with them. It would be amazing if you could wake up, sort of see the world for how it actually is, realize that the platforms that are enabling this gambling and speculative behavior are literally trying to steal your customers and steal your deposits, and actually treat this like a competitive threat, not just something I'm asking you to do to be overly paternalistic. It would be great if you could view it as a problem of competition that exists in a capitalist society, not some favor I'm asking you to do for your consumers because you feel bad for them. Please.
I want to give you two anecdotes. Anecdote number one is I sat with the chief product officer of a consumer neobank and their chief AI officer recently, shall we say. And they were saying that in their customer base, they absolutely see this. And that sports betting is becoming one of the top spend categories, and it's really concerning them. Yeah. And the internal debate is, can we even intervene? How would we intervene? What would we trip over if we did intervene? What would be the consequences of intervening? And it is very difficult. It's not a trivial thing to do. But this leads me to my second anecdote. In 2018, Monzo in the United Kingdom, over the course of a weekend, developed something in a hackathon that was a voluntary gambling block and a cool down period. So this is now a standard feature in every banking app in the United Kingdom, which is if you feel like you're on a bad run, then you can click a little feature inside of the mobile app, and it essentially freezes that merchant category code of sports betting or any form of gambling for 48 hours. And if you want to undo it, you can elect some friend, person, or somebody else to unfreeze it for you. So this is entirely opt-in on behalf of the consumer.
Sure.
And they got such good press from it that they guilt-tripped all of the rest of the financial institutions to getting it done. So I gave this story up to the CPO, and they said, I don't know if we've got the stomach for that. But I was like, well, there are very good PR professionals out there, and let's see if somebody can figure it out. I think there's a PR win waiting to happen for whomever does this thing. And I think if the consumer is ultimately in control, if they ultimately consent to this thing, they're saying, please block this for me. And if I want to unblock that, I have a process to do it, but I'm opting into this, and I'm opting into being able to opt out. Why wouldn't that work?
I mean, it makes all the sense in the world to me. And again, I think the really important thing that banks and fintech companies in the US, which we're a little newer on the whole sports betting thing than you guys in the UK are, so we're still kind of wrapping our heads around it. But like the thing you need to wrap your head around is, and I'll just pick on one example that's driving me crazy right now. But like Kalshi, I don't know if people know this, they offer like 4.5% interest on funds stored in their ecosystem. Like they offer a savings account. It's not called a savings account, but that's what it is. And so it's like you can't view this as just, it's not our job to tell our customers what to spend their money on. They can spend their money on whatever. It's deposit
Forget
flight.
about stable coins for a second. This is
exactly. It is like this is the deposit flight that is actually happening. And these companies, like, they want to become financial services companies because that's what everybody wants to become over time. These are competitors, and it's like you go out of your way not to make it easy for other competitors that you acknowledge to not steal your customers or steal your deposits. I don't know why we're treating this one with kids' gloves when in fact this one is actually much worse financially for your customers than your other more legitimate competitors are. So and it has more the mindset impact. Needs to shift. Right.
It has more P&L impact in the medium term and probably the long term, let's be really honest. Another idea to leave you with, the first large financial institution that does this as a feature has very little downside and a great PR win waiting to happen. It's very counter to where the market is. And actually, wouldn't it be weird if the big banks were the consumer savior? That is high ground that they have not had since 2008, and it's there for the taking.
It's just sitting there. Yeah. I mean, just to pick on them for a second, like JP Morgan Chase makes a huge deal with all the open banking stuff about we want to protect our customers. We're looking out for our customers. Well, here's the thing you could do as the largest.
Walk the walk.
Like if you have most consumer deposits in the U.S. of any bank, like here's a great example of a thing you could do. And I love the opt-in feature. Like just offer it. See what the uptake is. See if people like it. As we found out earlier with BNPL getting added to credit cards, consumers like this stuff. They appreciate having the option to do it. Add it to your account. It's the design pattern is already there. To your point, they built it elsewhere.
I am laying down the gauntlet.
I love it.
Whichever consumer neobank or large financial institution builds this first and gets it, send it to me and Alex, and we'll both cover it in our newsletter as the thing we cover that week.
Yes. We will. We absolutely will. That is a open standing offer. PR people just reach out to us when this product feature is ready, and Simon and I will be there to cover it. Simon, you'll be back next month to cover more fintech companies with me. I am so excited to continue doing this with you. Thank you for your time, sir.
Thank you. I always appreciate it. Thanks for manifesting with me.
Thank you for listening to this episode of Fintech Takes. Stay up to date with emerging companies and the latest fintech trends by subscribing wherever you get your podcasts. And if you love Fintech Takes, please tell a friend.